Friday, we zero in on March jobs.
A much anticipated jobs report.
The data are lagging and they are all over the place.
Fed tightening has consequences.
This Friday, it's a special Good Friday edition of Bloomberg Surveillance starting at 7 a.m.
What's the tea leaf I should be watching?
Do you think that this is an accurate response to the report that we just got?
You can't react to every bit of data.
The special Good Friday edition of Bloomberg Surveillance, Friday starting at 7 a.m. Eastern, leading up to the jobs report at 8:30.
Yes, it's finally happening. The French President Emmanuel Macron and the European Commission President Ursula von der Leyen are in China. They're there to basically push Beijing to end Russia's war in Ukraine. There'll be other discussions as well. And that takes us to our question of the day in this hour. Can Europe keep China and the US happy at the same time? Let's kick off the conversation. We're joined now by Bloomberg's Maria Tadeo. Maria, it's interesting. Emmanuel Macron has gone with VDL, Ursula von der Leyen. The message presumably is, because she's with him, that this is a unified European approach that Emmanuel Macron represents. My question is, does Emmanuel Macron represent Europe, and is Europe unified on the issue of China?
Well, the French president obviously represents the French Republic. That is clear to everyone. And von der Leyen, who's the head of the Commission, well, you could argue she is the one that is going to negotiate on behalf of the EU 27. But it is very clear that when Emmanuel Macron speaks, well, he speaks on his behalf. I think there's a number of things here. One is obviously there is going to be a meeting happening with the Chinese leader. When you listen to the words of the French president, he obviously believes there is value in this conversation. There's questions about whether China could be useful in Russia's invasion of Ukraine, whether they could use their clout over Vladimir Putin to de-escalate. But again, this is not a consensus position in the EU. There's other officials that believe this is entirely naive, that if China wanted to play its part and mediate to de-escalate, they could have done so already. They've had a year to do it, and they've not even called Zelensky once. And when I spoke to the Lithuanian foreign minister, just to give you an idea, he told me, in my view, well, China cannot be a mediator. Let's have a look.
Do you believe China will be ultimately the mediator in the war in Ukraine? Because you say Ukraine aims for victory. Mediation means compromise. Do you trust that China can do that, or is that something that actually they should not be even aiming for?
No, I don't believe that. No, because we've already seen that they are, aligning themselves, or they want Russia to align to their version of the global order, whatever that would mean from China's perspective. And definitely in that world order, Ukraine is not able to maintain the full sovereignty.
And that's Lithuania's Foreign Minister Landsbergis, who also told me, by the way, in his view, to call China's proposal a peace plan is wrong, as it does not will secure the sovereignty and the territorial integrity of Ukraine. So, Guy, when you talk about this issue, you can see here there's a lot of different opinions.
Yeah, a lot of different opinions, Maria, and at the same time, there is a point to be made about de-risking and decoupling, and that is a fine line to walk. Can Macron do that tomorrow?
Well, again, you could argue he is there with a delegation also of businessmen. Obviously, there has been criticism every time a European leader goes on a diplomatic mission with CEOs, because when you go to China to do that, well, you're there to cut businesses, to de-risk and also make new deals, may seem a contradiction. But this is when von der Leyen steps into the action here. One of the things that she said is that overall, when you look at trade between the EU and China, a lot of it is beneficial for the EU. There are areas, however, where China cannot play a big role. And obviously, we're talking about semiconductors, we're talking about chips, we're talking about high technology, and those areas the EU will have to de-risk. It's in that tension of what is profitable trade and what is a risky trade where von der Leyen is supposed to establish a common line for the EU.
All right, Maria, thanks a lot. Really great. Appreciate it. Bloomberg's Maria Tadeo joining us. Now, let's look at what this means for the U.S. Bloomberg Wall Street Week anchor David Weston joins us now. So obviously the U.S. is not going to be happy with what's happening with Ursula von der Leyen and Macron in China. How do they view this?
Well, they would like Mr. Macron to persuade President Xi to come over to their side. I think, though, that President Biden has to be concerned that it might go the other way, because I think President Xi's goal is actually to drive a little bit, at least a little bit of a wedge between Europe and the United States, which would be very threatening to the United States. I mean, the answer to your question, maybe, about whether Europe can keep U.S. and China happy, maybe only if it plays hard to get.
Yeah, that's interesting. So how does the US respond here when we see Emmanuel Macron in China with a delegation of CEOs? It's interesting, this comes on the same day as we get a story on the Bloomberg talking about the idea that Apple, for instance, is trying to sort of tiptoe away from China, its dependence on China. Is the US comfortable that the Europeans are basically further embedding themselves with every trip that is made into the sort of the economic sphere of influence that China operates in?
Well, certainly the United States, I think, would be foolish to think they're just going to have a total decoupling with China. It's the second largest economy in the world. It'd be foolish for anybody, including the United States, to say we're just not going to deal with you anymore. The question is, if it really is a swing vote between the United States and China, who is pushing it which way? Thus far, President Biden seems to have been playing a very effective game at saying EU, whether it's Ukraine or more broadly, stay with us. The question is whether President Xi can move over. And by the way, Guy, does President Xi have to do that? Because there were reports that some people around him were none too happy when he pledged his troth, if I can use that expression, with President Putin, saying, what are you doing? You're running risks of further decoupling with Europe. We can't afford that economically.
So, David, you talked to pretty much all the big players on Wall Street, on and off the record. The IMF said that about 2% of global GDP could be at risk if foreign direct investment was really hit by a U.S.-China rift. How do people then think about how to allocate the capital now when this is a severe risk and Europe's in the middle?
Well, it's interesting. I was with some people who deal with this, like the Business Roundtable people, and they actually tend to say they think the biggest risk right now out there is the risk of U.S.-China rift, that it could really jeopardize them because they have so much of the economy tied up with that. So they're very concerned about that. Above Ukraine, above taxes, above a lot of things you might think, they are very concerned about U.S.-China, first and foremost.
Do they think, David, we were in these conversations, do they think that if they don't do the business with China, the Europeans will do the business with China? Is there a fear that we're going to lose out? I only cite Boeing as an example. Airbus, I know the management is there in China right now with Emmanuel Macron. The 737 MAX still isn't certified in China. Is there a fear that if the US decouples and Europe doesn't, they get all the business?
So, Guy, it's a wonderful question that I suspect you know the answer to, because if you look back through history, typically that's exactly what's happened. Particularly, I must say, my impression is with France. France has not been too shy about backing their own companies in dealing with countries around the world. The U.S. has not always been as effective at that, at least from the U.S. perspective, as France and some of the Europeans are being. So they have to be concerned that, in fact, if they really do pull back, it will go to France, it will go to Germany, it will go elsewhere. China is not going away.
Right. Again, it's like a de-risking, decoupling, how to navigate that. David, really appreciate you taking time on your busy schedule for it. Wall Street Week's anchor, David Weston. All right, coming up, more on the question of the day. Can Europe keep China and the U.S. happy? And then how does that inform your investment decisions? Guy just made that point with Boeing and Airbus. Well, Monica Defend is head of Amundi Institute. She joins us next. This is Bloomberg.
So let's get back to our question of the day. Can Europe keep China and the US happy at the same time? And if it can, what does that mean for investors? We're joined now by Monica Defender, the head of the Amundi Institute. Monica, Europe has a different relationship with China. You see it in the success that LVMH is having, that Hermes is having, that Airbus is having. We see significant orders, significant business coming from China. How important is it for European investors that Europe does keep on side with both the United States and China?
Well, for Europe is pivotal to maintain good relationship, good economic relationship with both China and the US. And I think this is the strategic role that Europe can play in this redefinition of this new geopolitical order. So it's really good news that Macron is going to China together with Ursula von der Leyen, and this is really important for the region.
If Macron is talking about de-risking versus decoupling and kind of pushing the de-risking part, what does de-risking mean for the market?
Well, the market today has several worries that cause, in particular, to economic growth. So as long as we do whatever we can in order to preserve growth to decelerate too much or our recession to be too prolonged, it will be welcomed by the market. Honestly, with all the bad news that we have seen on the fundamentals, earnings recession, the market reaction on the risky assets overall is broadly positive, I would say, and surprisingly positive.
Monica, let's talk about how much of the China trade has already been priced into European equities. I look at the luxury sector. It has had an incredible rally. And I'm wondering how much more there is. How much of the China reopening trade is already in the price? Do you think there's much more still to come?
Honestly, I think that much is already on the price. And honestly, we think, and it is really good news, this reopening of China, but it won't be able to overwhelm the full deceleration of the economy starting from the US. So it's good news, but it won't be enough, because if the US turns into a recession, as we do believe it will be the case, this is not necessarily a good news for Europe.
No, it's not. But I also wonder, too, how are companies in Europe making their investment decisions now? Because it's not only the China and U.S. and trying to keep both happy, but it's also going to be about the IRA and reshoring and friendshoring, but then there's still high energy costs. If I'm a company, how am I allocating capital? And as an investor, how do you want me to be allocating capital?
I think that there are a few elements we need to consider. Strategic autonomy for Europe, having a clear industrial policy, might be really a game changer. If you think about it, US and China have a clear industrial policy, which is not the case for Europe so far, or at least we think that bottom up a lot more needs to be done in order to get into the strategic autonomy. When it goes to investors, honestly, uncertainty is so high that we have been shortening our investment horizon. So if you think about how to position 12 months ahead, really difficult. It's the visibility is getting shorter and shorter. So as investors, today we are much cautious.
Okay, what does cautious look like to you?
Cautious
how do I
means,
position if I want to be cautious?
Well, when it goes to equity, we are underweighting. We are back to bonds as a good risk diversifier, looking into commodities and real assets to hedge against inflation. So this is the kind of portfolio we have in mind.
Do you like gold? Is that the commodity you're talking about, or is it broader?
Yeah, you know, gold is a nice hedge vis-a-vis various risks, starting from the geopolitical in particular, and it's a commodity. So it's again something to have when you want to hedge versus inflation. It is a little bit difficult to size the exact positioning of gold when you look at the volatility of interest rates, because with interest rates rising, usually gold is not performing, and this has not been the case. So we've been also fine-tuning the positioning on gold, which is something that we think investors should have as a brick entrenched in the portfolio allocation.
Okay, final quick question. what do you think of the tech rally in the United States right now? It is a head scratcher for a lot of people. It's very concentrated in some of the biggest names right now. But it does seem to be the trade that if you get it right, you're ahead of the curve, ahead of the index. If you get it wrong, you're not. What do you make of that trade? And do you think, again, it's running out of steam?
Well, on this, we are a little bit more skeptical, as I was saying before. It is really on the 5 bit text that you not step back, but honestly, we are not positioning in a strong overweight. We think that moving forward, it is really a matter of stock picking rather than a top-down story to be played out.
Yeah, which was actually Guy's point at the beginning of the show. Monica, thanks a lot. Monica Defend, head of Amundi Research, joining us there for her take. We are just moments away from the European close. I should point out that the Nasdaq is still rolling over here, and as we head into the close, you have a little bit mixed equity picture. European stocks are down by about 0.5%. The DAX down 0.6%, but the FTSE eking out a gain here. This is Bloomberg.
So European equities coming into the end of the day. We are heading for a very long weekend. Thursday, Friday, Saturday. No, Friday, Saturday, Sunday, Monday. I need to get that right. We're going to be here tomorrow. And I wonder whether we're going to get some de-risking. The top-down view, to be honest, doesn't look very exciting for European equities. We're not doing that much today. Bit of a flip from yesterday. The London market outperforms the continental markets, the main ones, the DAX and the CAC, underperforming just a touch. But I don't think there's very much to see here. There is much more to see when we sort of flip it around and get a little bit more kind of bottom-up rather than top-down. This is the session. We kind of drifted lower. We're down by 0.2%, 456. But European equities at an index level aren't that far away from recent highs. So let's talk about what's happening on the sector level, because again, this is actually when things start to get a little bit more fun, I think. Telecoms are up today. Healthcare is rising. That's more defensive. So telecoms, healthcare, utilities, food and beverage, and the groceries are all up today. That tells you the market has definitely got a more defensive bias in terms of the stocks sort of sector story selection. Construction's down. The car sector's down a little bit today. Real estate's definitely down. Industrials are down a little bit as well today, though I thought the German data on the industrial front maybe a little bit better than anticipated today. Let's show you the single stocks, because this is where I think life gets a little bit more fun and it's worth spending some time on. Sodexo. Okay. Really solid numbers. This is the catering company, really solid numbers. It's also going to spin out its benefits business, and the market really likes this. A more focused business. The top line seems to be performing reasonably well. They've got a grip on what is happening in the middle. That stock really responding quite nicely today. So that's one French stock that's doing well. Beiersdorf in Germany up by 1.65%. Now, the gains aren't so great, but let me just give you a few superlatives surrounding this stock. It hit a 52-week high today. It has raised its sales guidance. It's hit a record high today. This is a company that is on a charge right now, and it's painting a really positive picture going forward from here. Skincare. Important, I'm told. That's Nivea. Airbus is down by around 0.7% today. Keep an eye on what happens tomorrow. Airbus's management team are in China with the French President Emmanuel Macron. They are pushing orders for the 350. Remember, this is a market that the Boeing is really struggling in. It's going to be fascinating to see what comes out tomorrow. But Airbus down a little bit today. This is a market that they have control of. How big a risk is that? I think that's a really important question for Airbus and so many other French companies that sees China as being so important. But it's fascinating to see what's happening there. That is going to be a key feature. Obviously, we've been building up throughout this week. We've got Emmanuel Macron and von der Leyen in China. We also get German data tomorrow. We've got the IMF curtain raiser coming through tomorrow. I think we've got an interview. I think Tom Keene is going to be doing an interview with Georgieva tomorrow. So we'll look forward to that. But this is going to be interesting. It'll be interesting to see what the big set pieces look like. Be interesting to see what's happening on the Russia-Ukraine front. I think that's going to be fascinating. And in so many ways, Alex, I think that will define the relationship between Europe and China, how China plays that Russia story, because that is incredibly important to Europe right now.
Yeah, and at the same time, you have Kevin McCarthy, Speaker of the House, meeting with Taiwan leaders in California, and that just puts even extra tension on all of this conversation. So let's get back to that question of the day. Can Europe keep China and the U.S. happy? We're joined now by Elvire Fabre, Jacques Deloire Institute Senior Research Fellow. Her area of expertise is geopolitics of trade plus U.S., EU, China relations. Pretty much the perfect person to talk to about this. Can Europe keep both sides happy?
Well, we remember that Ursula von der Leyen, the President of the European Commission, was in Washington not so long time ago, just a couple of weeks ago, and and presented a joint statement with Biden, which was presenting, very good future for closer cooperation on the transatlantic side. And ahead of her trip to Beijing, she just delivered a speech last week presenting, the main clarifying the European strategy towards China. And I think that the important element in this speech that was first that she was explaining that Europeans are looking to China with a very realistic view. China is on a strong inertia, and we don't expect to deviate from the main priorities of his economic development, but Ursula von der Leyen has the intention to re-engage with the problems of the asymmetry in access markets
and to re-engage on very specific issues that were already addressed in the bilateral investment deal that we signed 2 years ago, but which is now frozen.
From here, how does the relationship develop, and how important is it that China in some way manages to control Russia and Russia's war in Ukraine? How important is that relationship through Moscow into Ukraine in terms of the way that the Europeans are going to approach the Chinese relationship?
Well, Xi has been providing strong key support to Putin, and if we look at the evolution of bilateral trade between Russia and China, we see that those flows have increased very importantly during 2022, and that will continue. He will continue to be an export market for Russia. The main issue at stake in this meeting is really to insist on the red line, to avoid Xi providing some military support with any kind of military equipment, and that will be the first element, and most probably also trying to engage Xi to have a phone call with the Ukrainian president. Yes, Zelensky. Excuse me. Because when you look at the plan that Xi has presented for the peace plan, this doesn't look like a peace plan. It's only reminding what are the priorities for China and opposing the sanction policy. But now we need China, and we need President Xi Jinping to pave the way for a dialogue with Zelensky. But I think we have to be cautious with what we can expect on the Ukrainian side.
Yes.
Once again, it's more about underlining what are the red lines.
So that's sort of the geopol side. I'm wondering what a de-risking financially, trade-wise, looks of Europe to China versus decoupling.
Well, first of all, it means that identifying what are our excessive dependencies, and I think that we have moved pretty much on that side. We need to get to a more granular level, identify what are the sectors, what are the criteria to where we need to reduce those dependencies, and then to work on the governance. Is it about providing some support for the businesses? Is it about more state intervention, more regulations? But at least what it sends as a very clear message is that the EU is not following the US on a very wide decoupling strategy.
Yep. A lot of European companies ended up with a lot of stranded assets in Russia as a result of the Ukrainian war. European companies are engaged with China in a significant way. Is there a danger that those assets could also one day end up being stranded?
Well, that's a very specific worry for one member state, which is Germany. And when you look back at 2022, the main companies that were continuing investing in China were big German companies. And what they wanted to secure when they were traveling with Chancellor Scholz was precisely to be able to continue in investing in China. But it tells a lot about the rising anxiety that this market could be getting more and more complex. And the previous speaker in just a couple of minutes ago was very well underlying that the worries are more regulatory constraints. Yep. In the Chinese market, and I think that on the European side there's a clear intention to continue trade broadly with China. Now the specific concern is more about securing access to some raw materials, notably the critical the critical minerals, a sector in which China has a very has a leadership position and could exercise some coercive measures if it was to restrict those exports.
Elvira Fabry, thank you very much indeed. We greatly appreciate your time. Elvira Fabry, joining us from the Jacques Delors Institute, Senior Research Fellow there. Thank you very much indeed. Quick look where European stocks have settled. These are the final numbers that we're looking at on the screen. I argued just a moment ago that I think this is more of a bottom-up market today. Little bit of a fade maybe in the latter parts of the session. We do seem to be moving generally in that direction throughout the day. Coming up, we're going to take you back to the conversation surrounding the Fed, more of our exclusive interview, or Mike McKee's exclusive interview with Cleveland Fed President Loretta Mester. What did she have to say about inflation? What did she have to say about the Fed's rate path? Find out next. This is Bloomberg.
Just some quick breaking news for you. Switzerland is canceling or cutting bonuses for top Credit Suisse executives. In some ways, that's no surprise, but I'm sure it's not going to feel good to the Credit Suisse executives. Switzerland canceling or cutting those bonuses after UBS takes over, when UBS takes over the company. This is part of the deal. All right, let's get back to the market here. You're looking at the 2-year yield down about 12 basis points, and that sets us up for a Bloomberg exclusive that we had here. Cleveland Fed President Loretta Mester spoke earlier with Bloomberg's Michael McKee after the ADP number, but before the ISM services number that really moved the market. He talked to her about what to expect from the Fed's next policy meeting in May.
It certainly isn't my policy path. I mean, I think we're going to have to go a little bit higher from where we are, a little bit more, and then hold there for some time in order to make sure that inflation is on that sustainable downward path to 2%. That doesn't mean we're going to continue to raise rates until inflation gets back to 2%. We're going to be sort of calibrating in order to see that inflation is going to move down. And my own forecast is that it will take some time to get inflation back down. But I think we're going to make some appreciable progress this year and then continue to make progress next year and then hit 2% in 2025.
What's your trajectory for inflation? Where can we end the year and how fast would we get there?
Yeah, so I'm about 3 3/4% by the end of this year. Continued progress next year, maybe 2 3/4, and then 2% in 2025. And I think that's a good progress. But you got to remember, we've been at high inflation, well over 2% for quite some time. And that's why it's imperative that we continue to make progress and that we continue on this path. Now, we're going to be judicious about it. We're not going to, throw the baby out with the bathwater, as they say. We're going to make sure that we're making good judgments along the way. But it is crucial that we get inflation back down in a timely way to 2%.
All right, well, Mike joins us now for more on that. Also, Ira Jersey, Chief U.S. Rates Strategist for Bloomberg Intelligence. Mike, what do you think Laura Mester would have made of the ISM services number at 10?
Well, probably she would have said this is kind of what we expected to see. The economy is slowing down. The headline number falls, and it doesn't fall too far, but it does show some restraint. Perhaps the new orders index a bit of a problem, but that has gone down significantly before and then bounced back up again. And we see a slowing in the labor market, but not a collapse there either. Prices fall, although they do show in the ISM report that labor costs were one of the big movers in the prices this month. So they still see inflation out there, and they see an economy slowing. It's kind of going according to plan, if there was a plan.
Let's talk a little bit about what is happening, Ira, with the rate cut story. Are we in a position now where this is an economy, judging by the data, that we need rate cuts to be made real for pretty soon? I'm just kind of wondering how we should think about what is happening here with market pricing versus the data that we're getting.
Yeah, there's going to be, I think, a push and pull. Like Mike said, some of the data, particularly the ISM services data that we got today with the prices data down so much, it's actually the third largest decline on a month-over-month basis in history. And that tends to follow the the CPI services inflation. So when you look at the change in CPI services versus the change in that prices paid, it looks like, inflation's getting back to quote-unquote normal levels. And given that that services inflation has been one of the biggest drivers of inflation lately, I think that's really important. But to your question, Guy, about whether or not the Fed's going to cut later this year, the market certainly thinks there's a big risk of that. And given that Anna Wong from Bloomberg Economics just put out a piece this morning noting that there's a very high likelihood of a recession starting early in the third quarter, then the odds have to be priced in that the Fed may actually cut rates. But that doesn't mean that they will. It just means that there's a risk that they will. So the market's going to continue to price that probably even if they're not realized.
So Ira, to that point, the move that we've seen in the 2-year, is that a positioning story, or is it really, positioning for the weaker economy and the cuts? Is it fundamental? Is it positioning? I'm just trying to understand how to read those moves.
Yeah, so I still think there's a lot of people who have been in yield curve flatteners, so people who sold 2-year notes and bought 10-year notes thinking that curve would continue to invert. So I still think some of this is positioning, and when you look at some of the positioning data from the CFTC about futures positioning, it does seem like some of that still has to be unwound. But I think importantly, what the market's pricing today, and one of the reasons why you've seen this big rally in the 2-year note today, is the idea that even if the Fed doesn't cut early, and so might not cut in the third quarter of this year, for example, they might have to cut more later. And actually, that's our call. So our call is that the Fed is going to be slow to start cutting, but once they cut, they're going to cut very aggressively. And because of that, the market has to anticipate where we're going to be, not necessarily at the end of this year, but at the end of 2024, and that's where yields have to be lower to price for that.
Mike, is the Fed comfortable, is Loretta Mester comfortable being on a different page to where the market pricing is right now?
Yeah, they usually are. They have been even more so in recent months coming out of the pandemic. Nobody really knows what's going on. Fed was obviously offside with the markets over the whole transitory issue. And then you remember back at the beginning of March, the market was saying we were going to get 6% rates because Jay Powell said, well, maybe we could raise higher if we needed to. And now we're looking at these 4 rate cuts. So there's a lot of volatility in the markets, whereas the Fed sort of sails at a steady pace. They set their summary of economic projections every quarter and then just wait until the next quarter till they get all that data in and come up with a new prediction. So they know that they're not going to agree all the time. And as Loretta Mester said, we'll let the data tell the story.
So Ira, I have to wonder then, if you pair that with what Mike's saying from the Fed and what you were saying in terms of when they start cutting, they'll aggressively cut. Is the market pricing correct, but a year early?
Yeah, so I really think what the market's pricing is, and we put out a piece this morning actually looking at the distribution of SOFR options and where they're pricing for year end. And basically you have some people who think that the Fed's not going to do anything, and then you have other people who think that the Fed's going to cut maybe down to 2% by the end of the year. So there's this big, what I call bimodal distribution, where you have basically we're pricing the average of a disaster scenario where the Fed cuts a lot, and the Fed basically on hold and doing what Loretta Mester said to Mike earlier today.
Guys, we're going to leave it there. Fascinating conversation with Loretta Mester. Mike McKee and Ira Jersey of Bloomberg Intelligence. Tomorrow we're going to have an exclusive conversation with Kristalina Georgieva, the Managing Director of the International Monetary Fund. Looking forward to that. It starts at 10 a.m. New York time. That's 3 p.m. here in London. I just want to add something. I misspoke a moment ago. I said that the 737 MAX had not been certified in China. It has been certified, of course. It's just that deliveries haven't restarted to China from Boeing, which is an important distinction that I think is worth making. So apologies for that. A little mistake on my part. Anyway, this is Bloomberg.
We got a little flight to safety going on. We're kind of holding here around the lows. NASDAQ 100 off over 1% at those ISM numbers. Abigail's tracking the moves for us. Abby?
And it's a little bit of a puzzler, Alex, because we now have the the NASDAQ 100 down 3 days in a row, down 1.9%, the longest losing streak since February 22nd. And the reason I say it's a little bit of a puzzler, yes, we do have this eco data coming in a little bit lighter than expected. The ISM, though, still in expansion territory, but we have yields down dramatically. So per the old formula of last year and the year before, you would have stocks higher, especially technology stocks, because valuation would look better. That's clearly not what's going on. I would argue that maybe rather than it being a flight to haven or bond investors being fearful, that has more to do with consolidation of the big gains. This is the S&P 500, though, in this range. This is a new version of what we've been watching. It's so interesting. So take a look at this range over the last year. The S&P 500 very clearly sideways, but on the top of this resistance line that was drawn when the S&P 500 was still somewhere in between, it's bouncing right off. This is the RSI is going down.